Okay, I guess we can start. Good afternoon, Australia, and good morning, Europe, and especially Germany. My name is Jürgen Waldstabe, and I'm very happy to welcome you to today's industry focus webinar on the mining sector, on the Australian mining sector, for which I'm going to be your host and moderator today. I work for the German Australian Chamber of Industry and Commerce, or in short, AHK Australia, and I'm based in our wonderful Sydney office. At the Chamber, I'm a manager of the Competence Center for Mining and Resources, a project that is funded by the German Ministry of Economic Affairs and Energy, with the main task to support German mining supplies in Australia and to provide information on the Australian resources sector for the German industry. As we all know, mining is one of the most important industries for the Australian economy, including the mining suppliers. The resources industry contributes almost 15% to the Australian GDP. As all other industries, the mining sector has also been heavily affected by the COVID-19 pandemic. So if you are involved in the mining business or want to get involved in it, it is crucial to understand the metrics behind the crisis and its impact on the mining industry. So I'm really looking forward to the next hour where we're going to dive deep into the current situation of the mining sector in Australia. One really important thing at the beginning, I would like to encourage every participant in the audience to ask questions. You can ask the questions in the question box on the right bottom corner of the webinar screen. And all of our speakers today are really happy to answer your questions. And I'm convinced that an active exchange between our speakers and the audience can only increase the value of the whole webinar. Before we start with our keynote speaker, I would like to ask my colleague in the background, Eva Kosinski, to pull up a short poll that you should see on your screen now. And please answer those questions so we can give our speakers a good sense of the audience that they are dealing with today. You have I give you 30 seconds and then we should see the results. Good, Eva, I think that should be enough. If we can see the results right now. Okay, that's very interesting. So we can see that more than a quarter of the participants are suppliers to the mining industry and 17% consultants or service providers. So that means if you also include the others, yeah, so we have roughly half of our participants are mining suppliers or active in the mining industry. With that in mind, I would like to introduce our keynote speaker today, and that is David Thurtell, and you should also see David Thurtell on the screen right now next to me. David Thurtell is manager of the Resources and Energy Economics team at the Office of the Chief Economist. David is also editor of the great publication Resources and Energy Quarterly, which is, as you could guess from the name, published quarterly. Resources and Energy Quarterly provides in-depth analysis of production volumes, prices, and values of Australia's major mineral and energy commodities exports, iron ore, coal, gas, gold, copper, and many others. The latest edition was published yesterday morning, and I'm sure that David and his team worked extra hard this time to include the effects of the coronavirus pandemic on the global resources demand and therefore on the Australian resources exports. I'm really excited to have David as part of our webinar today. And yeah, David, the stage is yours.
Thank you very much, Jürgen, and welcome everyone today. Look, as you can see on the screen, and as Jürgen said, we released our quarterly yesterday. Now, I have about 25 slides, and I always include too many slides so that at least you've got something to go back to. It's better to put too many slides in than put not enough. So, look, I'll just quickly go through those slides. Basically, Jürgen is right. The coronavirus outbreak has definitely made our job much harder, I should say. And I guess to sum up, we do expect that it will have an adverse impact on our resources and energy exports. As you can see there, we now think that in the year just ending in the next few hours, 2019-20, we estimate that Australia will export $293 billion, but that's going to fall by around about $30 billion next financial year, and slightly more the year after that, to about $257 billion. Essentially, what has happened is that the coronavirus and the associated containment measures have had a deep impact on oil consumption and therefore on oil prices. And that's flowed through to LNG export revenue projections, because LNG exports from Australia, 70% of them are linked to the price of oil. You've also seen sharp falls in the price of metallurgical and thermal coal. On the bright side, though, I guess we have had some strong prices for iron ore, and we expect export revenues to be over $103 billion in 2019-20, the year just gone, and around about $97 billion next year. So supply issues are at the centre of that outlook, and I'll get into those further in a moment. The other good, I guess, sort of bright spot is the strength of the gold price as the COVID hit and central banks dropped interest rates. Real bond yields have declined, which has lowered the opportunity cost of holding gold, and there's been also safe haven demand for gold. So as you can see in the overview there, you can see on the top right-hand chart, iron ore is sort of way out in front of the other main commodities, but Australia does have sort of a handful of other commodities that make us, in the order of 10 to 20 billion, $10 to $40 billion a year. Resources and energy exports ran about 8.7% of GDP and accounted for something like 58% of all goods and services from Australia in 2018-19, employed almost 250,000 people. The bottom right-hand chart shows that from a customer point of view, China is definitely the elephant in the room when it comes to our major buyer. It's more than double Japan, which is the next biggest buyer, and Japan is double South Korea, which is the next biggest after that. So in terms of the impacts on the commodities, as you can see there in the chart, thermal coal prices were coming down right through 2019 as the world economy slowed on the back of US-China trade tensions. Now, the COVID outbreak has just accelerated that decline, but it seems as though thermal and met coal prices have just about bottomed for now. As you can see, the dark blue line is the iron ore. Essentially, a couple of factors of influence. So when the COVID outbreak first occurred, iron ore did dip in price, but then you had weather disruptions in both Brazil and the Pilbara in Australia, and you had quite resilient Chinese steel production. In more recent sort of weeks and months, worries about the continued operations of mines in the major mining regions of Brazil have also led iron ore prices to rebound, and they're around about $100 a tonne right now. as you can see in this next slide, there's just a dramatic slump in GDP growth we're going through right now. Some of the major economies in the world, namely, say, the Eurozone and the US, we're looking at, slides in GDP growth of sort of been between 7 and 10%, which is essentially the worst decline since the Great Depression in the 1930s. Growth then springs back in 2021 as the pandemic recedes, and as government stimulus packages start to really hit home. In terms of, I guess, there's concerns that the outlook may have been sharply impacted by, may sharply impact on capex intentions. So far, we can't detect anything alarming in the data. You can see there that on the right-hand chart that mining capex in the year just about to end in the next few hours is slightly up from last year, and it's expected to grow slightly in the year after that. Essentially, what we've seen is the end of that LNG wave of capex in the sort of 2011 right through to 2018-19. So the LNG plants built, notably the ones off the Queensland coast at Curtis Island, have involved expenditures of tens and tens of billions of dollars. And now that those projects have completed, capex spending has come off. You can see, though, that the lighter blue colours, things are starting to pick up. Coal mining and metal ore mining expenditure is starting to has been recovering for a few years, and so we're not sort of too pessimistic on that outlook. I'll just go to slide 8. You can see what we do in our major projects analysis in each December edition of the quarterly. We look at every single project in Australia over the value of $50 million, and we add them up. We also assign what we think is the likelihood that they will go ahead, and you can see there that the signs are promising for a significant pickup in project investment over the next few years. Just in terms of the next slide, just drilling down, I guess, into the individual commodities. The left-hand slide shows the premiums and discounts achieved by the various grades of iron ore. Now you can see that big mountain in sort of 2018, early 2019, the dark blue line. That was for the higher grade iron ore, actually largely from Brazil. But as there was a tailings dam collapse at one of the major mines in Brazil in January 2019, and what you saw is that as the supply of higher grade ore dried up, steel mills, particularly in China, were happy to pay similar money for lower grade ores just to get their hands on material. So the premium and the spread between high grade ore and lower grade ore narrowed pretty sharply. You can see on the right hand side the iron ore price spiked up in 2019, went up to almost $120 a tonne. Since come down, down below the sort of $80 mark, but then rebounded. In terms of our expectations, on the left-hand side, you can see that Australia is, in recent years, has exported the majority of, or more than any other country, of exports. Brazil has struggled to really increase production, and the tailings dam collapse, and now with the COVID outbreak, it looks as though they're going to struggle to increase supply very significantly over the next year. On the right-hand side, you can see that again, volumes continue to rise, but our export revenues are expected to come down as price falls over the coming year. Just moving on to thermal coal and other exports, you can see there in terms of exporters, Indonesia is by far and away the largest exporter, and Australia is close behind. Russia, the devaluation of the ruble in 2013-14 really has strengthened their export competitiveness, and they're really starting to be, a growing participant in the thermal coal market. You can see that on the right-hand side that exports haven't been too badly affected so far in 2020. China remained a strong buyer, mainly because with the new calendar year, quotas had ticked over and buyers were keen to get material on board. We expect that will start to decline a little bit in the next coming months, because essentially the monthly quotas have been more than filled, and it's likely that in the next few months the annual quota will come close to its ceiling. So slowing Chinese demand is certainly a concern going forward. In terms of the gas, you can see there, that's one of our infographics that goes through the different types of uses by sector, and it also looks at our status as now the largest exporter in the world in 2019. As I said before, 3/4 of our gas is sold on a long-term contract, and the price at which it's sold is linked directly to the Japanese custom cleared crude price. So if the price of oil declines, that goes directly into the LNG price with a 3-month lag. And because of that sharp decline in the oil price when COVID hit, we're expecting a very significant decline in LNG prices achieved under contract sales. The spot price in Asia has declined dramatically as the industrial demand for power has slowed as containment measures arose in the COVID, in many Asian countries in Asia during the lockdown. You can see there on the bottom right-hand slide that export revenues are going to slide from close to 50 billion, I should say, in the year just gone. We're expecting export revenues to be trimmed by, sort of at least 15 billion in the year financial year just about to start. Gold, you can see some of the impacts of the COVID outbreak. World jewelry consumption in the year to the March quarter has declined pretty sharply. Gold sector buying has also been hit, notably from countries like Russia. You can see the bottom right, the bottom bar though, exploration expenditure has really responded quite dramatically to the stronger price outlook. And that's one of the reasons why we're expecting a steady flow of new projects to come on stream, and also expansions over the coming year. You can see there that gold on the left-hand side, gold is set to be third highest export earner after LNG in 2020-21, and you can also see on the right-hand side that Australia is set to overtake China as the world's largest gold producer in the coming year. So I guess one of the reasons why Australian gold producers are so happy is that you can see there Australian gold price has hit a all-time record at around about $2,500 an ounce. And if you combine that strong price with the fact that oil prices, the cost of the energy has fallen, and interest rates are low, the miners' costs are very low, and so margins are very, very high. On the bottom chart, you can see the gold price tracks pretty closely to the movements in the real US Treasury bond yield, 10-year bond yield. Basically, as bond yields have gone down, the opportunity cost of holding gold also declines, and so it's more attractive to hold gold, and that drives up the price. Just quickly, wanting to dwell on, the world energy transformation. Australia is now the biggest producer of lithium. We have significant deposits of graphite, and we have the second largest cobalt reserves in the world. And we are the world's sixth largest nickel miner. And nickel sulfate is the fastest growing battery metal. We're the world's seventh largest copper miner. So we think that we're very, very well placed to be at the center of what we're framing as the world's energy transformation. As the world transitions away from fossil fuels towards electric vehicles and renewables, the use of batteries, wind turbines, electric vehicles, all of which, of course, use lithium, nickel, copper, and cobalt. We think that's going to rise dramatically, and we think Australia is very well positioned in that sense. Electric vehicle sales have been impacted by the COVID outbreak. As with other new vehicle sales, essentially people stopped visiting car sales rooms. But the data that we're seeing from China and from other major countries show that vehicle sales are starting to recover pretty strongly. The other factor, I guess, is that in many countries, commuters are shunning the use of public transport. They're using more private vehicles, and that's going to lead to more demand for new vehicles, and that's going to have some spin-offs for electric vehicles as well. In terms of the copper outlook in our copper reserves, you can see there, as I said before, there's copper to be found in practically every state of Australia. Top left-hand chart. Basically, the average home contains 180 kilos of copper. An internal combustion engine uses about 30 kilos of copper, but an electric vehicle uses about 80 kilos. So we think that increased use of electric vehicles, but also things like wind turbines, which use something like 2 tons of copper each, the large ones. Copper is one of the standouts for, as I said before, for the energy transformation that we see coming. Nickel, of course, is used heavily in some of the batteries, and its role there is also very, very promising. Again, and finally, lithium. With the role of lithium in a lot of these lithium-ion batteries, we think Australia is extremely well placed there, and also because we have very, very cheap gas still in WA, where they've had a gas reservation policy. We're starting to see now lithium being processed into lithium hydroxide before it's then exported to Asia and to other countries. So we're getting further and further up the lithium chain. There has been an oversupply of lithium in recent years, but we think that oversupply is gradually going to recede. So thank you very much for your attention, and I'll throw it back to Jürgen for the other participants.
Of questions, and we we have really, I see we have some very interesting questions. So yeah, I think it's 5 or 6 questions. So let's go through a couple of them. If you wouldn't mind popping them up on the screen. So the first question here, I think was about gold exports, and maybe not only next year, but I think in their past recent years, your chart showed that the production of gold in China was declining a lot. So why is that?
Yeah, look, good question. I mean, I think essentially in China, if you like, the low hanging fruit has essentially been picked. Some of the easier deposits have been exploited over recent years. And so, some of the reserves are being depleted fairly rapidly. And so that's, I guess, why we're expecting slightly, slower production from China over the next year or so.
And that does not apply for Australia, like depleting ores?
Look, definitely, yes. The sort of the really high grade ore has been exploited, but we keep on looking for and finding other quite good deposits, and I guess the Australian dollar gold price is a major driver too, because it's so strong. That really has led to a lot of expansions and also new mines, and even sort of reopening of mines that have been closed for 20 and 30 years. So, the gold price, the Aussie dollar, weakness of the Aussie dollar combined with a strong US dollar gold price really has driven Australian gold exploration and expansions.
Thank you. Maybe on to the next question, if you wouldn't mind. Yeah. This question is about the ratio of met coal used to make steel. So why do we see the two divert so much from each other?
Yeah, look, again, that's a good question. It's really a supply issue. So, the supply of met coal in recent months and quarters has not slowed to anywhere near the same extent as it has for iron ore. So last year, January 2019, as I said, there was a tailings dam collapse at the Bermuda mine in Brazil, which not only closed that mine but also led the authorities in Brazil to force the closure of other mines with similar tailings dam designs. And so Brazilian supply has struggled for the last close to 18 months. You also had weather problems in the Pilbara earlier this year. And so iron ore supply to the seaborne market has been very constrained in the first half of 2020, where met coal supply was, if anything, quite strong. Particularly, you've got to remember that China produces more met coal than any other country, and it's been opening new mines and increasing transport links, and the supply of met coal has been quite strong.
I see. So we're seeing a switch from, or China is using more of their own met coal for their
Correct.
steel
Correct.
production.
And I guess the other thing is, yes, and the other thing that's really hurt the met coal is that the demand for met coal has declined because the lockdown in India, this 3-week lockdown, which has since been extended, has closed a significant amount of steel capacity in India. And so Indian demand for met coal has dried up very, very rapidly.
Great, thank you for that. I think we have time for 2 or 3 more questions. Maybe we take the next one. So this one is about driving infrastructure booms by the governments subsidizing or putting out money to the industry. Is it likely that we see something like that again after this current crisis?
Good question again. Look, there's evidence to suggest that China is indeed already embarking on an infrastructure drive, but we're not so sure that it will be to the same degree or extent as what we saw post GFC. Essentially, in 2008, 2007 and early 2008, China was ready with a lot of infrastructure projects, but the economy was starting to overheat. The government put them on hold in sort of mid 2008. Then the GFC occurred in September, sort of 2008 was, I guess, the real peak. And China quickly rolled out an expansion program of around about $580 billion. In the intervening sort of 12 years, China has racked up quite a lot of debt, and leverage in the Chinese economy has increased quite dramatically. And the government is much less inclined to allow a housing boom and a construction boom for housing and residential housing. And so one of the major drivers of steel consumption will not be there to the same extent as it was in 2009-10. But there will be some infrastructure spending and demand for iron ore and other inputs.
And maybe also not only from China, but from other countries worldwide that drives demand from Australia.
Yeah, that's right. I guess no one comes even close to China in terms of infrastructure spending at the moment. I guess the hope is that countries in Southeast Asia, but also like countries like Vietnam, Pakistan, Bangladesh, the Philippines, will start to really spend and start to use, increased infrastructure. And of course, the big sort of elephant in the room, though, for some years, will be India. And fingers crossed that India can quickly stomp out the coronavirus outbreak, because India's potential is very, very strong going forward.
Thank you. We have time for one or two more, but quick questions or quick answers. So let's take the next one, and then I think we can move on to the panel discussion. So this one is about Olympic Dam expansion of Olympic Dam. Do you know anything about that?
I do not. Olympic Dam is not infrastructure as such. Obviously, it has roads and electricity supply and water supply going to it, and maybe the Prime Minister was talking about that sort of associated infrastructure, but I have not heard anything about fast tracking of the Olympic Dam. Surely that's a decision for the owners, BHP.
Yeah, I mean, the chamber, we organized a delegation last year to Olympic Dam, and it is a running, operating mine, and I think they are looking to expand the mine, but as you said, I'm not sure what that has to do with the infrastructure there. I see one more interesting question on the screen. Maybe let's do that and then really go to the panel discussion.
One of the was also about diversity. So what you've seen over the last 5 years is in South America, notably in sort of Argentina, Chile, is development of brine mines, lithium mines, and operations, where they take brine from salt lakes and stuff. That's come at the same time as the hard rock development of Australia's mines. Of course, the hard rock stuff in Australia can be processed into lithium hydroxide, whereas the South American material it goes into lithium carbonate and then has to be processed again into hydroxide. So we think that Australia has got a cost advantage, and we're keen to see the Australian industry develop. But there's also been quite a lot of development of Australian mines and capacity, to the point where perhaps there was over expansion, that the demand for lithium from electric vehicles and the like wasn't picking up as fast as the supply, mine supply, etc. in Australia. So yeah, that's one of the reasons why the oversupply developed. But there has been sort of some cutbacks in Australia, and we're expecting the demand will pick up very, very strongly over the remainder of this decade, and the market will balance fairly soon.
Great. Thanks a lot, David. And yeah, I think it's time to move on with our panel discussion. Before, as I said before, and thanks a lot for the question from the audience. And please also during the panel discussion, please ask more questions. In the end, we will have like 5 minutes left to have another Q&A session. So let me introduce the panelists, and while I do so, please, I invite the panelists to turn on their camera. So let me start with Andre Kluge. Andre is Country Manager Pacific and Managing Director at Schaeffler Australia. Schaeffler is an international company based in Germany, nearly 90,000 employees and a turnover of more than 14 billion euros. And Schaeffler is a big supplier to the automotive industry, but also many industrial sectors, and is best known for high quality rolling bearing solutions. And I think, Andre, in Australia, mining is the most important market for Schaeffler.
Yes, that's right. Thanks, Jürgen, for the introduction.
You're very welcome. Next up is Oliver Kleinhempel. Oliver, please turn on your camera as well. Oliver is Managing Director of Cronimet Holding in Germany and a non-executive director of Specialty Metals International. Cronimet is a German company active in the metals trade and metals recycling business with more than 1,600 employees and revenue of 2.4 billion euros. And recently, Cronimet has expanded to Australia and has entered a joint venture with an Australian mining company called Specialty Metals International. And together, they have just recently commissioned a tungsten production by reprocessing tailings and stockpiles of Mount Carbine mine in Queensland. Welcome, Oliver. And then let me just introduce our last guest, and that is Stephen Sampson. Welcome, Stephen. And Stephen is Managing Director at Vulcan Australia. And Vulcan is another German family-owned company, has 1,200 employees and 170 million euros of revenue. And Vulcan produces industrial couplings, clutches, and brakes for many industry. And again, mining is one of the most important industries for Vulcan. Hello, Stephen.
Thank you for the introduction. Good afternoon or good morning, as it may be, to everyone.
Great, thank you. And again, obviously, David is also part of the panel. So David, please stay on.
Of course.
And before we begin with the panel, my colleague Eva has prepared another little poll, which you should see on the screen in a second. And we would like to know from the audience how their businesses have been affected or impacted by the COVID-19 pandemic. Let's wait a couple of seconds until everybody has voted. Okay. Eva, please show the results. So what we see here is, as you might expect, you don't see any business that has been affected positively by the virus, but 28% has seen a neutral impact, so not really negative as well, and only 22 and 4% negatively or very negatively. And that doesn't look too bad. And if you look at the future, it looks quite similarly. We see a bit more negative than neutral, but no, very negative again. So similar, but I think the future will tell, and we can't really know exactly right now. But let me take those answers of the audience and hand that over to our first panelist. Let me ask Stephen, do those answers reflect what's happening in your business right now?
Yeah, I think so. I think that what we've seen in our business from the COVID-19 is, I think you saw a first phase, which was where I think sort of March, April, where business dropped off dramatically as companies tried to work out how they could operate as business as usual, from employees moving to home office, things like that. But from then on, at least from the mining sector, we've seen it accelerate back to normal levels, what it was before. I think certainly on iron ore, for instance, it's really been very, very strong. So I think now that we're a few months into it, most businesses are operating quite normal.
Thank you, Stephen. And let me ask the same question, Andre. What about in your company? What about at Schaeffler Australia?
I think I would also go with a neutral statement. We have to say that we see finally a dip in on the East Coast, where we had, as explained, some impacts coming from the coal and maybe some insecurity even from investments. On the other side, we see quite good investments and planning on maintenance cycles on the West Coast, especially in gold and iron ore, as they increasing their outputs, of course, coming from this very good commodity prices at this stage. But there is a change in mindset, ongoing with the miners. So that's maybe something what I see as positive. The COVID more or less accelerates the need for change.
Thank you, and I think that's a theme that we will see in the future as well. As soon as there is, trouble, or as soon as sales are not that high, then companies focus a bit more on change and how to make their production better. Let me ask the next question to Oliver. Oliver, as you are, or as your company is producing minerals in Australia, have you also started to make changes to your production or to your company, or has it not really impacted you yet?
Well, thanks first of all, Jürgen, having us on this panel, and thanks for the question. I mean, as an operating asset, I think we work fairly isolated up in far north Queensland. Indeed, if you would have visited us, which obviously wasn't possible throughout COVID, but we did have actually a police force right in front of our gate. And I personally was stuck the last 3 months that side. I just returned to Germany a week ago. And so we were impacted on obviously restrictions related to logistical matters. We didn't have any COVID case within the organization, which certainly helps. Most of our employees are coming from within the region, within the Shire. That also helps. So we didn't have to depend on any fly in, fly out arrangements. So yeah, knocking wood, for our case, for our project, I can say luckily we had been one of those sites which hadn't been directly impacted. The only, let's say, minor impacts probably came out of logistics of spare parts and contractors coming in as needed. going through certain procedures, obviously, to move around site without much, let's say, interaction with other employees. But yeah, I would say we had been probably lucky so far, and from that point of view, it's to be observed on how obviously overall demand for commodities will be impacted. I think there are some winners and some clear losers out of the pandemic and with a projection for the coming months. But other than this, we are optimistic that we can keep producing at the levels where we are now.
That doesn't sound too bad. And what about the price and the demand for tungsten? Do you see anything, any trends there yet?
Well, tungsten historically has always been a bit, the price has been reflecting the GDP growth or sentiment from a global scale. Tungsten is mainly used as a carbide material, hardening steel, and for the production of tools which are used in the manufacturing sector as a consumable, as well as a main commodity for hardening, surface hardening for defense equipments. So we don't see really a major drop on the demand side. There was a slight correction on the pricing throughout the last 6 months already. So I would say the fluctuation, the variance is rather minimal, and we do see a fairly positive outlook coming now with the governments going to obviously reactivate their economies, drive manufacturing, drive infrastructure. So from that point of view, I believe we are really bottom out when it comes to the price. The demand is obviously now depending really on the economic activity and the manufacturing ramp-ups in the Western world primarily.
Thank you, Oliver. And maybe David, you heard what Oliver said about the price bottoming out. Does that also apply to other like rarer metals that you haven't touched on in your presentation?
Look, to be honest, we don't track rare earth prices that closely. So I don't want to go out on a limb and give any view. Certainly, the major commodities seem to have passed. The worst seems to have passed. The coals, base metals, and I guess we do expect that iron ore will fall, but from very high levels as Brazilian supply recovers, and gold will fall as some of that safe haven demand comes away, and as bond yields start to rise.
Thank you, David. Moving back to the mining suppliers, one of the themes I have heard from many mining suppliers in the couple last months was that they had issues with in the supply chain, like getting their products from all over the world to Australia. Andre, maybe asking you the question, do you see that in your company as well, and what was the biggest impact in that?
In the space of supply chain?
Supply chain,
yeah. Yeah, of course. I think everybody could really experience what's happened during shutdowns. Finally, 95% of all airplanes were grounded, and that means this was a dramatic change in air freights. We are depending here especially on emergency shuts and so on. You need to find a way to bring product into the country. So we had a price increase just overnight by factor 5, which was, absolutely impossible to calculate, to be honest, and caused a lot of questions and problems. On the other side, also you saw a lot of delays on the sea freight. A lot of countries closed their harbors and let the ships or the vessels more or less waiting in front of their borders. So this was a big problem for us. We planned a little bit ahead, so we have some local stock here, but not for everything. But hope this will ease soon. The other supply chain issues, what was described by Oliver before, is of course the problem to bring people on site, go through all the processes, and support a customer, even maybe virtually, instead of sending people on site to help them to get their machine maintained. So that's more or less where the challenges in the first weeks. But now I think it's a little bit, how to say, eased. And we are hoping that with this, with the new situation, finally, we find also new ways to support the customer much faster now with digital solutions.
And do you also, maybe asking Stephen, do you also see, or does that happen in your company at Vulcan, that you are going a bit more local into the markets and having more stock there, or even starting productions in the most important markets to be more resilient against future disruptions, or is that not something you're doing right now?
It is. I think, luckily for us, just through the timing of that process or a program that we already had in the company over the last 2 years, was to take a look at our supply chains within our own organisation around the world, and with a view to bringing the costs down and the timing down for supply out of factories into, say, Vulcan Australia. And what that meant was that we had already embarked on a process. We have 5 factories around the world, and we'd already embarked on a process to move production so that it's generally closer to the customer, and also to de-risk the business through having production not only at one factory, so to take away a little bit of that single supply source through our factories. So, once we would have relied on Brazil for many of our products that go into the mining industry, but now they can come out of Germany and they can come out of India. So we have the ability to transfer across through the different factories. But we had exactly the same issues around freight, air freight costs, etc., that Andre was describing. And for us, I think that business going forward, we're starting to stock a bit more, and probably just invest a little bit more in stock in uncertain times to try and create the ability to either, depending on which market segment it is, to create more market share, or to at least shore up our market share.
So it seems like a first measure is having a bit more on stock to help during future problems. And especially right now, we don't know when the COVID crisis is over, so it might be that more restrictions are coming again, and then air freight would go up again. And so I guess having stock is, or your products in stock right now, is a good first measure to help you through the crisis. Maybe touching on another topic that is not so much related to COVID-19 is the whole movement towards more sustainability. And we have seen that in the mining industry recently, or over the last couple of years, that more and more of the mining companies are also moving towards zero emissions, and have put out their strategies for net zero emissions. And I think even during the crisis, during the pandemic, we have not seen many companies weakening their goals when it comes to sustainability. So I guess going more sustainable does also mean investing in technology. Andre, do you see more demand on that side for your products?
Yeah, indeed. Finally, we are in discussions with different mining companies to say how to equip their machineries more with online monitoring equipment, help them to switch their their sites from an offline plant to an online plant. That's first steps. Finally, if you talk about sustainability, of course, you talk about where to get the energy from and so on. So they're building up solar plants or wind farms and so on. These investments, I think it's still a bit slow from our end. We see investments coming, but also the government needs to accelerate their approval process here, because they're also part of this investment. On the other side, on the sides, what you see quite often is also protecting of people. Yeah, so that's the change. What you see to really, how to say, get the transparency of the equipment. Only order the people when they're really needed. Otherwise, just keep the equipment running, and maybe also improve the efficiency. Yeah, so that's where we are helping.
Cool, thank you. Oliver, is that something you are also preparing to do, like net zero or reducing emissions for your mine in Queensland?
Well, I would say overall, just to come back generally to your statement on sustainability, I think that is these matters are not options anymore. They are must-dos, and every project, every investor, or every stakeholder, as Andre mentioned, I mean, there's collaboration required between government, between the investor itself, between communities, etc., and between all of them at the end of the day. And in order to achieve certain goals, but they have to be specifically set for each site. And it's not the question on what you are doing or what commodity you are extracting, but it's also the question on how you do it. Certainly, the net zero targets, I wouldn't put them out loudly as we speak. We do actually see a big wind park development happening not far from the mine site that we operate. But the question is obviously on allocation of these slots. But generally, sustainability is in the DNA of Cronimet Group as being a large metal recycler, and that is what we transfer. That know-how is what we transfer now towards the mining sector, and absolutely that's driving our investments. If there's no clear pattern towards a more sustainable operation, we would not look at investing into projects. So that's a mandate that we have from our shareholders, and I think that's a mission which is strongly supported by many stakeholders and primarily driven by the consumers. I think all what we see now, and there's a lot happening already, that's really driven by consumers raising their voices, putting pressures. The internet has obviously served, and social media is doing their part. So from that point of view, I think we are on a good path, and collaboration is key. I just want to highlight that what we really experience in Australia specifically, that there's great institutions from the universities. We do have very strong ties with the Sustainable Mineral Institute of the Queensland University, and you have to interact with the research sector. You have to understand what are the technical theories, let's put it that way, what's the scientific capabilities, and then have to find ways on how you transition your company, your operation step by step into it. And anybody, being it the suppliers, technology partners, research, as I mentioned before, I think we all have to work much closer in order to materialize on these opportunities.
Thank you very much for that. That's almost sounded like a brilliant closing word, given that it is 1 minute past 5 already. But maybe again, last question to you, Oliver. It's you have invested in Australia, and it's not very often that we see German mining or German companies seeing doing an investment in the Australian mining sector. Are you looking at investing in further mines in Australia?
Well, I mean, speaking as Cronimet, certainly would like to team up with miners across the board. Obviously, commodities that are within our portfolio, from nickel, molybdenum, cobalt, etc. So we're looking for opportunities. We are a private company. Most of the Australian mines are held by ASX listed vehicles. And that's why you saw our cooperation with Specialty Metals International, being an ASX listed company, having the leverage towards the capital market, and obviously being able to manage the investor relations side within Australia. As a stock listed company, obviously you have to report a lot. It's a very transparent way of doing business. So we do like to cooperate further through Specialty Metals or through Cronimet directly. I think that's depending on each and every project. But I think it's a safe jurisdiction from a legal point of view. Now with a weakening dollar throughout the last 12 months, I think was quite supportive for the mining sector, as David also highlighted. I think OPEX can be driven down significantly just by exchange rate and leverage or arbitrage, and the oil price is supporting as well. Infrastructure is key, obviously. Depending on where the location is of your project, you might have to put up a significant amount of money first to be able to deploy equipment and people to site. So these are a couple of criteria that we use to assess our opportunities. And yeah, but other than this, personally, we are very bullish on Australia, and I think with the mix of commodities that have been highlighted by David and the cycle where we are in, and geographically sitting quite close to the Asian main consumers, I think Australia is definitely a key investment hub, and we want to be part of it. Yeah.
That sounds brilliant. Thanks again, Oliver. And I think that also sounds good for mining suppliers, and maybe we can see some collaborations in the future. It is 5:04 now. I think we have to close here now. I don't see any further questions from the audience. People in Germany have to start their working day, and people in Australia can slowly go into their, as we Germans say, Feierabend. Thank you very much, David, Oliver, Stephen, and Andre for participating. It was an honor, and I really hope we can do similar webinars in the future together.
You're welcome.
Yeah, thank you, Jürgen. Thank you.
Thank you very much, and you have a wonderful evening.
You
Thank
too.
you.